Two numbers from the same session. Goldman Sachs, up 9%, closing at an all-time high. IBM, down 25%, its worst single day since 1987. Same market, same index, same 6.5 hours. And the S&P 500 finished up 0.4%, inside a 58 basis point range, as though neither of them happened. That gap is not noise. It is measurable, and it has a number. This is the AlgoIndex market close for Tuesday, July 14th. The S&P closed at 7,544, up 0.38%. Chips rallied 3%, the Nasdaq added about 1%, and the volatility index dropped to 16.5. Ahead, the one reading that explains how a record and a collapse fit in the same flat session. The number that priced this entire day before the inflation data even printed. The 11-month bet somebody placed on Goldman at a strike 26% away. And how our desk traded it. The S&P 500, 7,544, up 0.38%, 38 basis points, on a 58 basis point range. The Nasdaq 100, up about 1%. Semiconductors led at +3. The volatility index closed at 16.5, down 3.7%, and its own volatility gauge finished at 93.5, down nearly 2%. So the options market got calmer on an inflation day. Now the part that does not fit. The put-call volume ratio came in at 1.62. Traders bought far more puts than calls, and the market went up anyway. Three drivers, each with a number. First, the catalyst. Inflation came in soft. That lifted stocks and bonds together and took a rate hike further off the table. Semiconductors ran 3% and carried the Nasdaq up about 1%. Second, the flow, and this is where the day gets strange. At the index level, real-time dealer hedging flow was flat on the day. Flat. The index basically did not attract directional money. And what did trade was same-day options. But on the single stock side, that same flow registered plus $3 billion. And the composition matters more than the total. Plus $4 billion in longer-dated call buying against $1 billion of put buying. More than half of that call buying sat in the Mag 7. That is not a bet on today. That is positioning for earnings. Third, the mechanics. And this is the part worth writing down. Before the inflation number even printed, the same-day straddle was priced at $45.50 against a 7,515 reference. That is 60 basis points. That was the options market's quote for how far the S&P would travel on an inflation day. It traveled 58. The market priced the entire session to within 2 basis points, hours before the data came out. That is not luck. It is enforcement. The index sat in positive gamma, about $316 million of gamma notional, which means dealers were leaning against every move rather than feeding it. And one position did most of the work. Roughly 7,000 same-day contracts were sold in a four-legged structure, bracketed at 7,585 and 7,590 on top, 7,470 and 7,475 underneath. Whoever put that on needed the index to stay between those rails, and the hedging it forced compressed the range all afternoon. Your chart shows a quiet day. That quiet was manufactured, and you can name the position that manufactured it. Which brings us back to the two numbers we opened with. 1-month implied correlation closed at 4.6 against a key level of 8. And it did not just sit there. It was reading 6 at 7 o'clock this morning, and it fell to 4.6 by the bell. So the unhooking got worse as the session went on. When correlation sits that low, index moves and single stock moves come apart. Goldman can print a record. IBM can lose a quarter of its value, and the index can absorb both and finish up 0.4. The calm is not strength. The whole day was decided in 1 hour, and it respected the map. The open was 7,537. Sellers took it straight down to 7,513 at 10:20, and that low is not a random print. It stopped 4.5 points above the 1 standard deviation support at 7,509. And here's the thing that tells you how tightly held this day was. It never went anywhere near the real downside structure. The options implied daily low was 7,481, 32 points lower. The pivot that separates bullish from bearish sits at 7,480. the market never even asked the question. Then, in 15 minutes, it ripped 44 points to the high of the day, at 7,557 by 10:35. And that high stalled 31 points under the implied daily ceiling at 7,588. Both ends of the day died well inside the band the options market had already drawn. After 10:35, nothing. 6.5 hours of range, and the entire day was built before 11 o'clock. The close, at 7,544, landed 9 points above the volatility inflection level at 7,535, which is the line that kept dealers dampening rather than amplifying. The map into tomorrow: support at 7,520, then 7,500, which is also the primary gamma concentration strike, then 7,450 and 7,400. Resistance at 7,560, 7,575, then the gamma ceiling at 7,600. The gamma flip level sits at 7,471. Above it, dips get absorbed. Below it, they get amplified. Goldman Sachs reported, beat, and ran 9%. The options market had priced a 4% move, so it delivered more than double what it was paid for. Real-time hedging flow, in the name, hit plus $183 million, its largest positive reading in 30 days. It broke through the 1,100 gamma strike that had been capping it, and closed at a record 1,140, up 25% on the year. And then, somebody did this. Roughly 1,000 call contracts, June 2027 expiration, 1,440 strike, paid at $63 a contract. Call it $6.3 million of premium. That strike is 26% above where the stock just closed at a record, with about 11 months to run. That is not an earnings trade. Somebody thinks Goldman is worth 1,440 before next summer, and was willing to pay up on the day it was most expensive to do so. One caveat, and we will say it plainly: this print comes from the end-of-day options read, which flagged it for confirmation in tomorrow morning's flow report. We are calling it provisional until it clears. The other side of the ledger. IBM missed on sales and lost 25%, its worst day since Black Monday in 1987. And it got worse as it went. It was down 18% before the open, and it closed down 25%. So this was not a gap that stabilized. It was a gap that kept bleeding for 6.5 hours. Hedging flow there hit minus $309 million, its most negative reading in 30 days. But look at what traders did after the collapse. Implied volatility in the 175 to 195 strikes fell by double-digit vol points, while implied volatility at 260 to 270 rose by double digits. They sold the downside and bought the upside. After a 25% drop, the options market started paying up for the recovery. This is the tell we flagged earlier. S&P implied volatility closed at 13.4%. 30-day realized volatility is 14.9. Implied is a vol point and a half below what the market has actually been delivering. And IV rank is 17.6%, meaning options are cheaper than they have been for roughly 4/5 of the past year. Volatility across strikes fell across the board today, and this week's expiration lost 1.5 to 2 vol points. So, put that together with a 1.62 put-call ratio. Traders are buying a lot of puts, and they are buying them cheap, because the market is charging almost nothing for protection right into producer prices, 2 chip earnings, and expiration. Skew is only mildly tilted, with the 25 delta risk reversal at minus 0.05. When insurance is priced below what the market is actually delivering, the asymmetry favors owning it rather than selling it. That is the actionable line tonight. Our desk today: 4 trades, 2 winners, 1 loser, 1 break-even. Single leg, defined risk, as always. The environment did the teaching today. With the index pinned in positive gamma inside a 58 basis point range, chasing direction was the losing trade, and fading the edges was the paying one. Our one loser came from treating the morning drop as the start of a move, when it was actually the day setting its range. We took what the structure offered, and did not force size into a market that had already decided how far it would travel. Process over hunch. Into tomorrow and the week ahead. Bias neutral with a mild upward tilt. Medium confidence. The end-of-day options read marks 7600 to 7625 as the ceiling into Friday if inflation data and geopolitics stay quiet. Now the price map, and it lines up almost too neatly. Max pain for tomorrow sits at 75.35, 9 points below the close. So, the near-term pull is sideways to slightly lower. Now look at where that number is. 75.35 is also the volatility inflection level. Tomorrow's pin and the line that decides whether dealers dampen moves or amplify them are the same price. Friday's monthly expiration is a different story. Max pain there is 7,505, 38 points below where we closed, 0.5% of downward gravity into the end of the week. The highest probability magnet strikes are 7,598 at 99%, 7,575 at 96, and 7,553 at 96. The implied daily move is 0.71%, so the market is paying for a band between roughly 7,481 and 7,588. The calendar is dense. Producer prices and ASML earnings tomorrow. TSM the day after. Monthly expiration Friday. And here is the mechanical risk that matters. The same read that marks the upside also says every ingredient for a sharp drawdown is present and only a trigger is missing. Expiration is expected to release the positions that have been holding this index steady. If implied correlation is still under 8 when that happens, the cancellation effect that absorbed a 25% single stock collapse today gets weaker, and the index stops being able to hide. We are 1% under the 52-week high of 7,621. And momentum is not stretched, with the 14-day relative strength index sitting well below its overbought line. So there is room. What changes the bias? A close under the 7,480 pivot turns this bearish, and a close over 7,600 opens the upside zone. We publish this every session. If you want the tools behind it, our AI trading journal is free at members.algoindex.com/auth/signup. We also publish a live gamma level accuracy tracker at algoindex.com/tools/gamma level accuracy, which scores these levels forward in public. Written analysis is at algoindex.com/blog, and the trading community is on Discord. Trade the structure, not the story.